Friends, in this video, we will look at the functions of the financial system in detail. The financial system performs an interrelated functions which are essential for a modern economy, like it provides a payment system for the exchange of goods and services. It enables the pooling of funds for undertaking large scale enterprises. It provides a mechanism for spatial and temporary transfer of resources. It provides a way for managing uncertainty and controlling risk. It generates information that helps in coordinating decentralized decision making. It helps in dealing with the incentive problem when one party has an informational advantage. Now we look at each of these points in detail. Depository financial intermediaries such as banks are the pivot of the payment system. Credit card companies play a supplementary role. To realize the importance of this function, simply look at the hardship and inconvenience caused when the payment system breaks down. Modern business enterprises require large investments which are often beyond the means of an individual or even of hundreds of individuals. Mechanisms like financial markets and financial intermediaries, which are an integral part of the financial system, facilitate the pooling of household savings for financing business. If you look at it from the outside world or the other side, the financial system enables households to participate in large individual indivisible enterprises. Transfer of resources. The financial system facilitates the transfer of resources, economic resources across time and space. As Robert Merton says, a well developed, smooth functioning financial system facilitates the efficient life cycle allocation of household consumption and the efficient allocation of physical capital to its most productive use in the business sector. A well developed, smooth functioning capital market also makes possible the efficient separation of ownership from management of the firm. This in turn makes feasible efficient specialization in production according to the principle of comparative advantage. Risk management. A well developed financial system offers a variety of instruments that enables economic agents to pool, price, and exchange risk. It provides opportunities for risk pooling and risk sharing for both household and business firms. The three basic methods for managing risk are hedging, diversification, and insurance. Hedging entails moving from a risky asset to a riskless asset. A forward contract, for example, is a hedging device. Diversification involves pooling and subdividing risks. While it does not eliminate the total risk, it redistributes it to diminish the risk faced by each individual. Insurance enables the insured to retain the economic benefits of ownership while laying off the possible losses. Of course, to do this, a fee or insurance premium has to be paid. Price information for decentralized decision making. Apart from the excuse me, apart from the function of facilitating individuals and businesses to trade in financial assets, Financial markets serve an important latent function as well. They provide information that helps in coordinating decentralized decision making. It is put in this way by Robert Merton. Interest rates and security prices are used by households or their agents in making their consumption saving decisions and in choosing the portfolio allocations of their wealth. These same prices provide important signals to managers of firms in their selection of investment projects and financings. Dealing with incentive problem. When one party to a transaction has information that the other does not have, informational asymmetry exists. This leads to the problem of moral hazard and adverse selection, which are broadly referred to as agency problems. The nature of these problems may be illustrated with the reference to insurance. A person who has taken a fire insurance policy is likely to become somewhat negligent. This is the moral hazard faced by the insurance company. A person who is more likely to experience fire losses will be inclined to take fire insurance. This is the adverse selection problem faced by the insurance company. Financial intermediaries like banks and venture capital organizations can solve the problem of informational asymmetry by handling sensitive information discreetly and developing a reputation for profitable activity. Now, in this video, I will be briefing you about the financial institutions and the financial services, which falls under financial intermediaries. So, what does financial intermediary or who is a financial intermediary? Financial intermediaries are the firms that provide services and products that customers may not be able to get more efficiently by themselves in financial markets. For example, a financial intermediary is a mutual fund which pools the financial resources of many people and invests in a basket of securities. It enjoys economies of scale in conducting research, in maintaining records, and in executing transactions, and hence it offers its customers a more efficient way of investing than what they can generally do on their own. The important products and services of financial intermediaries are checking account, savings account, loans, mortgages, mutual fund schemes, insurance contracts, credit rating, and so on. So, we will discuss about what is the rationale behind financial intermediaries. That is, what are the benefits to individual investors when they invest indirectly through financial intermediaries rather than directly in operating companies? So, there are several advantages of doing so. So, what are these advantages? Diversification. The pool of funds mobilized by financial intermediaries is invested in a broadly diversified portfolio of financial assets, that is stocks, money market instruments, bonds, debentures, loans, etc. These individual investors can scarcely achieve such diversification on their own. And an investor also should remember that a diversified portfolio reduces the risk of investment. And the next benefit is lower transaction cost. The average size of a transaction of a financial institution is much higher than that of an individual investor. The transaction cost in percentage terms tends to decrease as the transaction size increases. Hence, financial intermediaries compared to individual investors incur lower transaction costs. Economies of scale is one of the advantages of making use of financial intermediaries. Buying and holding securities, or for that matter, granting loans and supervising them, calls for information gathering and processing and regular monitoring. These functions incurs cost. Financial intermediaries, thanks to their bigger size and professional resources, enjoy economies of scale in performing these functions, and hence they have a comparative advantage over individual investors. And the next benefit is the confidentiality. Companies seeking funds or the continuing support of existing investors are required to disclose information that they like to keep confidential for competitive reasons. They would feel more comfortable in dealing with few financial intermediaries rather than numerous individual investors. Information shared with financial intermediaries may be kept confidential, whereas information disclosed to numerous individual investors falls in the domain of public knowledge. And the last benefit, and not the least, is signaling. With greater professional expertise at their command, financial intermediaries can pick up and interpret signals and cues provided by companies which are in this manner, financial institutions perform a signaling function for investing community. So now we will discuss about the key financial intermediaries. The key financial intermediaries in India are commercial banks, financial institutions, insurance companies, mutual funds, non-banking financial companies, and non-banking financial service companies. So, what are commercial banks? Commercial banks would be a public bank, that is the public sector bank, it would be a foreign bank, or it would be a private sector bank, which represents the most important financial intermediary in the Indian financial system. Public sector banks, led by the State Bank of India, came into being largely on account of nationalization of privately owned commercial banks. Presently, they dominate the banking scene in the country. They have contributed immensely to wider geographical spread and deeper penetration in rural areas, higher mobilization of deposits, and reallocation of bank credit to priority sectors. Foreign banks such as Citibank have been in India for a long time and they have been steadily expanding their operations. The newest entrant on the commercial banking scene have been the private sector banks like HDFC, ICICI, and so on, which were set up in mid 1990s in the wake of banking liberalization. This segment has shown remarkable growth and vitality since the beginning. Financial institutions. Since independence, a number of financial institutions have been set up to cater to the long-term financing needs of the industrial sector and meet specialized financing required. An elaborate structure of financial institutions consisting of all India term lending institutions like IFCI, ICICI, IDBI, SFCs and state industrial development corporations has come into being. There are many specialized financial institutions like Small Scale Industries Development Bank of India, Export Import Bank, National Bank of Agriculture and Rural Development, Shipping Credit and Investment Corporation of India, Power Finance Corporation, Rural Electrification Corporation, Infrastructure Development Finance Company, and National Housing Bank, so which are specialized in lending loans for different sectors. Insurance companies. Till recently, there were just two insurance companies in India, the LIC and the GIC, that is the Life Insurance Corporation of India and General Insurance Corporation of India. Life insurance General Insurance Corporation of India being a holding company with four fully owned subsidiary companies in its fold. With the liberalization of the insurance sector, many private sector players like ICICI Prudential, Tata AG, Bajaj Allianz, Birla Sun Life, and HDFC Standard have set up insurance businesses in India. Insurance companies, LIC in particular, have massive resources at their command because insurance policies usually have a substantial element of savings and insurance premiums are payable in advance. Mutual funds. A mutual fund is a collective investment vehicle. It mobilizes resources from investors and we invest in varieties of securities. That is, it invests in various types of securities. While there was only one mutual fund in India, the Unit Trust of India, till 1986, presently there are a number of mutual funds in public and private sector. In the last decade or so, private mutual funds like ICICI Prudential Mutual Fund, Reliance Mutual Fund, and Templeton Mutual Fund have grown impressively. Non-banking financial companies. From mid 1980s, many non-banking financial companies have come into being in the public sector as well as private sector. Some of the well-known names are HDFC, Sundaram Finance, Kotak Mahindra, ICICI Ventures, Infrastructure Leasing and Finance, and SBI Factors. These companies engage in a variety of activities like leasing finance, hire purchase finance, housing finance, venture capital financing, factoring, and investment in securities. Non-banking financial companies. This group consists of merchant banks, credit rating agencies, depositories, and others. Merchant banks are firms which help businesses, government, and other entities in raising finances. They also facilitate mergers, acquisitions, and divestitures. DSP Merrill Lynch, JM Morgan, ICICI Securities, and SBI Capital Markets are among the leading merchant banks in India. Credit rating agencies rate debt and other instruments. CRISIL, CARE, ICRA are the leading credit rating agencies in India. Depositories are institutions which dematerialize physical securities and effect transfer of ownership by electronic transfer. Presently, there are two depositories in India, the National Securities Depositories Limited, that is NSDL, and the Central Securities Depositories Limited, which is CSDL. So friends, it is important for any finance manager to know about the different financial intermediaries and the financial services that are available in the country for an effective running of the business and for an effective decision making. Video, we will look at the various functions of the financial systems. The financial system performs an interrelated functions that are essential to a modern economy, like it provides a payment system for the exchange of goods and services. It enables the pooling of funds for undertaking large-scale enterprises. It provides a mechanism for capital and temporal transfer of resources. It provides a way for for managing uncertainty and controlling risk. It generates information that helps in coordinating decentralized decision making. It helps in dealing with the incentive problem when one party has an informational advantage. Friends, now we look at each point in detail. That is, it provides the payment system for the exchange of goods and services. Depository financial intermediaries such as banks are the pivot of the payment system. Credit card companies play a supplementary role. To realize the importance of this function,